At 2:37 p.m., Tokyo time yesterday, a transaction was confirmed, $130 per ounce for physical silver. While at that exact same moment, the COMEX exchange in New York showed $80, a $50 spread. Not theoretical, not speculation. Actually traded, actually paid, documented, verified, confirmed by multiple dealers. The same metal, the same day. Two completely different prices. And the banks holding short positions just realized their nightmare has become real. Welcome back to Economy Reverse. The transaction occurred at Tanaka Kikinzoku, one of Tokyo's oldest and most respected precious metals dealers, operating since 1885. A corporate buyer, later identified as a mid-sized electronics manufacturer, purchased 5,000 ounces of physical silver at $130 per ounce. The total transaction value exceeded $650,000. The purchase was documented with standard invoicing, payment confirmation, and delivery scheduling. This was not a back alley deal or gray market transaction. This was a legitimate above-board purchase at a premium that should not exist under rational market conditions. At the moment this transaction settled, the COMEX futures contract for silver was trading at $80.12 per ounce. The spread between what the Tokyo buyer paid and what New York futures showed was $49.88. For simplicity, call it a $50 spread. In percentage terms, the Tokyo buyer paid 62.5% more than the COMEX price. To put this in perspective, imagine buying a car for 62.5% more than the sticker price when identical cars sit on dealer lots across town at full price. Nobody does that unless the cars on those lots aren't actually available for purchase, despite what the price tags say. This is not the first time Tokyo dealers have sold silver above COMEX prices. Premiums have been climbing for months. 6 months ago, Tokyo premiums ran about 15%. 3 months ago, they hit 30%. Last month, they crossed 50%. But yesterday's confirmed transaction at $130 represents a psychological and mathematical threshold. The spread has grown so large that it can no longer be explained away as temporary logistics issues or currency fluctuation effects. This is evidence of permanent structural breakdown between paper and physical markets. Multiple independent confirmations came in throughout the day. Another dealer in Tokyo's Ginza district confirmed similar transactions at $128. A dealer in Osaka reported $126. Seoul dealers in South Korea were quoting $122 for immediate delivery. Singapore dealers reported $118. Even dealers in Hong Kong, typically more connected to Western markets, were quoting $110. The pattern is unmistakable. Physical silver trades at massive premiums throughout Asia, with premiums highest in Japan and declining slightly as you move toward markets with better Western connectivity. The mechanics of why this spread persists reveal the market failure. Under normal conditions, arbitrageurs would immediately exploit such gaps. They would buy silver on COMEX at $80, take physical delivery, ship it to Tokyo, and sell at $130, pocketing the difference minus shipping and handling costs. Shipping costs for silver run perhaps $2 to $3 per ounce, including insurance. Even with all costs, the arbitrage profit would exceed $40 per ounce. This should be free money, and in functional markets, traders would flood into this opportunity until the price gap closed. But the arbitrage isn't working, which tells experienced traders everything they need to know about COMEX delivery reliability. Traders are not buying COMEX contracts and taking delivery because they don't trust they'll actually receive metal within any reasonable time frame. COMEX delivery delays have stretched from the traditional few days to several weeks, and in some cases months. Stories circulate within trading communities about contracts that supposedly delivered, but where the metal never actually appeared. Force majeure clauses are being invoked more frequently. Cash settlement is being substituted for physical delivery against contract holders' wishes. The refinery allocation crisis compounds the delivery problem. Global silver refineries operate at maximum capacity, with waiting lists extending 9 to 12 months for new orders. Refineries prioritize customers paying physical market premiums over those seeking to fulfill exchange delivery obligations. Why would a refinery allocate precious capacity to a COMEX delivery at $80 when they can sell the same refined silver to industrial buyers at $130? The economics are obvious. This creates a situation where even if a trader wants to buy on COMEX and deliver to Tokyo, they cannot get the refined product in timely fashion to execute the arbitrage. Exchange inventory tells the same story. COMEX registered silver inventory, the metal actually available for delivery against contracts, has declined by 40% over the past year. Weekly withdrawal rates have accelerated. Each week, more metal leaves the vaults than arrives. The remaining inventory becomes increasingly concentrated among fewer holders, suggesting that much of what remains may not actually be available for general delivery. Some of this metal belongs to entities using COMEX vaults for storage, but with no intention of selling at current prices. It's registered inventory on paper, but not actually available supply in practice. The legal structure of COMEX contracts provides another clue. These contracts allow for cash settlement under certain circumstances, spelled out in dense legal language that most traders never read until it's too late. When physical delivery becomes impossible or impractical, the exchange can settle contracts in cash based on the paper price, not the physical price a buyer would actually pay in the market. This means a trader holding a contract at $80 might receive $80 in cash settlement, even though the physical metal he thought he was buying trades at $130 in the real market. The buyers paying $130 in Tokyo are not irrational speculators or uninformed retail investors. They are sophisticated entities making calculated decisions based on specific needs and constraints that override price sensitivity. Understanding who these buyers are and why they're willing to pay such extreme premiums reveals the structural nature of this crisis rather than temporary market dysfunction. Corporate treasuries represent a significant portion of premium buyers. Japanese corporations, sitting on massive yen-denominated cash reserves, face a dilemma. Keeping cash in banks earns negative real returns as inflation erodes purchasing power faster than interest accrues. The yen's 40% decline against the dollar over 3 years has devastated the international purchasing power of these reserves. Corporate financial officers, tasked with preserving company assets, are increasingly viewing physical silver as a treasury reserve asset, something that would have been unthinkable just 5 years ago. Electronics manufacturers form another major buyer category, but their motivation is operational rather than financial. These companies require silver for production. A smartphone contains approximately half a gram of silver. A laptop uses roughly 1 gram. Solar panels need 20 grams each. These manufacturers cannot simply stop production because silver prices have risen. They have contracts with customers, employees to pay, factories to operate. Their choice is stark. Pay whatever premium necessary to secure silver supplies, or shut down production lines and face bankruptcy. When framed that way, paying $130 per ounce becomes a survival decision rather than an investment choice. The just-in-time inventory model that dominated manufacturing for decades is collapsing in real time. That model worked when suppliers could be trusted to deliver materials reliably at predictable prices, when silver could be ordered and received within weeks at prices close to exchange quotes. Maintaining minimal inventory made financial sense. But when delivery times stretch to months and prices diverge by 60% from exchange quotes, the old model breaks catastrophically. Manufacturers are shifting to strategic stockpiling, purchasing 6 to 12 months of silver requirements, despite the capital costs and storage expenses involved. Ultra-high net worth Japanese families are paying premiums for different reasons entirely. These families, often multi-generational wealth holders, remember Japan's post-war currency collapse. Grandparents tell stories of savings becoming worthless overnight. This cultural memory creates sensitivity to currency risk that Western wealth holders lack. When the yen began its recent collapse, these families didn't wait for government reassurances. They moved decisively to convert yen-denominated assets into physical commodities that cannot be devalued by central bank policy. Family offices managing these fortunes view the premium not as a cost, but as insurance. If the yen continues collapsing, the premium paid today becomes irrelevant compared to the wealth preserved. If Japan faces banking system stress or capital controls, physical silver held outside the banking system provides liquidity and portability that bank deposits cannot match. These buyers are essentially paying $50 per ounce for optionality and risk reduction, which looks expensive until a crisis actually hits. Sovereign-related entities add another layer of demand, though these purchases happen quietly without public announcement. Asian central banks cannot officially announce large precious metals purchases without triggering market reactions and diplomatic complications, but metal moves nonetheless through intermediaries and unofficial channels. Sovereign wealth funds face similar constraints but similar motivations. Diversify away from dollar-denominated assets, build strategic commodity reserves, hedge against monetary system instability. The common thread across all these buyer categories is that price sensitivity has disappeared. They're not asking whether $130 is expensive relative to $80 on COMEX. They're asking whether they can secure physical metal at any price, and whether that metal will be available next month if they wait. Once buyers shift to that mindset, normal price discovery mechanisms break down entirely. The market becomes not about price, but about availability and certainty of delivery. This psychological shift, once established across broad buyer categories, cannot be reversed by falling COMEX quotes or regulatory interventions. The premium becomes permanent because the underlying concerns about paper market reliability are justified by observable delivery failures. The $50 spread between Tokyo and COMEX prices cannot close through increased supply because the supply side faces constraints that will take years to overcome, not months. Understanding these constraints reveals why the current situation represents a structural crisis rather than a temporary imbalance that market forces will naturally correct. Global silver production totals approximately 1 billion ounces annually, a figure that has remained relatively flat for the past decade despite rising prices. This production stagnation has a simple explanation. 70% of silver comes not from dedicated silver mines, but as a byproduct of copper, lead, and zinc mining operations. These mines produce silver almost incidentally, and their output depends on base metal economics rather than silver prices. A copper mine doesn't increase production because silver prices have doubled. It increases production only if copper economics justify the expansion and silver comes along for the ride. The remaining 30% of supply comes from primary silver mines, but bringing new mines online requires 7 to 10 years under optimal conditions. That timeline includes exploration, drilling, feasibility studies, environmental assessments, permitting, financing, construction, and commissioning. In practice, timelines often stretch longer. Permitting alone can take 3 to 5 years in major producing countries like Mexico, Peru, and Canada, as environmental regulations have tightened considerably. Even if mining companies decided today to fast-track new silver mine development, production would not increase meaningfully until the early 2030s. Existing mines face their own challenges that prevent rapid production increases. Silver ore grades have been declining for decades as higher grade deposits are exhausted and mining companies dig deeper or process lower grade material. This means more ore must be processed to produce the same amount of silver, increasing costs and environmental impact while limiting production growth potential. Many mature silver mining operations are in decline, with annual production decreasing as deposits deplete faster than new reserves are discovered and developed. Refinery capacity represents another critical bottleneck that prevents supply from responding to higher prices. Silver must be refined to appropriate purity standards before it can be used in most applications or sold through major dealers. Global refinery capacity operates near maximum utilization, with backlogs extending 9 to 12 months for new orders. Building new refinery capacity requires significant capital investment, environmental permitting, and technical expertise. More importantly, refineries prioritize allocating their limited capacity to customers paying physical market premiums rather than fulfilling exchange delivery obligations at depressed paper prices. The recycling flow that typically increases when prices rise has largely failed to materialize. Historically, higher silver prices brought scrap metal back to market from old jewelry, silverware, and industrial waste. But modern silver consumption patterns have changed. Industrial silver gets locked into products like electronics and solar panels, where recovery is technically difficult and economically unviable. The old film photography industry that once provided substantial recycling flow has virtually disappeared. Jewelry and silverware holders who might have sold at previous price peaks are now hesitant, sensing that current premiums might be just the beginning of a larger move. Geopolitical factors add further supply constraints that cannot be quickly resolved. Mexico and Peru together produce roughly 40% of global silver, and both countries face political instability, resource nationalism, and community opposition to mining expansion. China has periodically restricted silver exports to prioritize domestic industrial needs. Russia's production, while smaller in global terms, is effectively cut off from Western markets due to sanctions. These geopolitical fragmentations mean that even existing production capacity cannot always flow freely to where demand is highest. The mathematical reality is unforgiving. If Japanese demand alone increases by 100 million ounces annually, that represents 10% of global production. Add similar demand surges from other Asian countries, continued industrial consumption growth from solar and electronics, and investment demand from other regions recognizing the supply squeeze, and available supply gets overwhelmed quickly. The market cannot rebalance through supply response on any timeline relevant to current buyers, which is exactly why those buyers are willing to pay such extreme premiums to secure metal today, rather than waiting for supply that may never come at reasonable prices. The confirmed $130 trades in Tokyo and the $50 spread over COMEX pricing carry implications that extend far beyond the silver market itself. This price dislocation represents the first major crack in the derivative market structure that underpins global commodity trading, and the precedent it sets will cascade across other markets with devastating consequences for the financial system. The COMEX exchange faces an existential credibility crisis. For decades, commodity futures exchanges served as the primary price discovery mechanism for physical markets. Producers, consumers, and investors all referenced exchange prices as the benchmark for transactions. But when physical metal trades at 62% premiums to futures prices, the exchange has lost its most important function. Industrial buyers can no longer use COMEX prices for hedging or planning purposes because those prices bear no relationship to what they actually pay for metal. Mining companies refuse to enter forward sales contracts based on COMEX pricing because they can sell directly into physical markets at far higher prices. Speculative traders exit the market as they realize the futures price has become divorced from underlying reality. Banking sector exposure to this spread widening creates systemic risk that regulators have yet to acknowledge publicly. 4 major banks hold concentrated short positions totaling over 800 million ounces. When these positions were established at prices between $40 and $60, they appeared manageable. Banks could reasonably expect to close positions by purchasing offsetting contracts or delivering physical metal acquired through normal supply channels. But at current COMEX prices of $80, these banks already face mark-to-market losses exceeding $15 billion. If positions were valued at Tokyo physical prices of $130, losses would exceed $40 billion. These are not theoretical numbers. These are actual cash obligations that come due when contracts settle or when margin calls must be met. The spread widening creates impossible choices for these banks. They can attempt to cover short positions by buying contracts at current COMEX prices, locking in substantial but manageable losses. But this assumes enough contracts are available for purchase and that counterparties will accept COMEX-priced settlement. Alternatively, they can attempt to acquire physical metal to deliver against their short positions. But this requires paying Tokyo-level premiums and securing metal that may not be available at any price. The third option is default, declaring force majeure and settling contracts in cash based on COMEX prices despite the physical market trading far higher. This option destroys the bank's reputation in commodity markets permanently and likely triggers lawsuits from counterparties who expected physical delivery. Capital adequacy concerns emerge quickly once these derivative losses are recognized. Banks already carry substantial unrealized losses on bond portfolios purchased when interest rates were near zero. Adding tens of billions in commodity derivative losses on top of bond losses threatens the capital ratios that regulators require banks to maintain. If capital ratios fall below regulatory minimums, banks face restrictions on dividends, share buybacks, and potentially lending activities. In extreme cases, capital inadequacy can trigger regulatory intervention or forced mergers. The concentration of silver short positions among just 4 institutions means that if one faces serious distress, contagion concerns spread immediately to the others. The pattern emerging in silver will spread to other commodity markets because the underlying dynamics are not unique to silver. Platinum already shows physical premiums approaching 40% in Asian markets. Palladium faces similar supply constraints with even smaller market size. Gold, while having a much larger and more liquid market, is beginning to show early signs of physical paper divergence in certain Asian markets. Copper faces massive supply deficits as electrification drives demand while mine development lags. Each of these markets operates with similar derivative structures, similar fractional reserve dynamics and exchange inventories, and similar concentrated short positions among major banks. Currency market implications cannot be overstated. The yen's collapse accelerates as wealthy Japanese convert bank deposits to physical silver at any premium. Each transaction involves selling yen and either purchasing dollars to buy from international dealers or buying from local dealers who themselves must source inventory using foreign currency. This creates relentless selling pressure on the yen that the Bank of Japan cannot counteract without depleting foreign exchange reserves that are already declining. Other Asian currencies face similar dynamics as the physical precious metals buying wave spreads regionally. The timeline for crisis escalation depends on which breaking point hits first. Conservative scenarios assume 12 to 18 months before major derivative defaults or exchange rule changes become necessary. Base case scenarios compress this to 3 to 6 months as physical premiums continue widening and bank losses become unmanageable. Aggressive scenarios envision crisis within weeks if a major bank announces inability to meet commodity derivative obligations or if an exchange suspends physical delivery. The Tokyo trades at $130 are not isolated incidents, but confirmation that the crisis is already underway. The market has split permanently into paper and physical tiers, with paper prices becoming increasingly irrelevant to actual commodity transactions. Banks holding short positions face mathematical certainty of catastrophic losses, whether they cover at COMEX prices that cannot secure physical delivery or acquire actual metal at premiums that destroy their capital bases. This is not a problem that resolves itself through normal market mechanisms, because the normal mechanisms have already failed. The $50 spread is not noise or temporary dislocation. It is proof that the derivative system has broken, and what broken silver will break across commodity markets systematically, until authorities are forced to choose between protecting bank balance sheets or maintaining any pretense of functional commodity price discovery. A choice, when it comes, will reshape the financial system for a generation.